If you live in Europe and keep all your savings in the bank, you're probably losing value right now. Inflation is slowly eating away at your hard-earned money. But the good news, you can start investing, even with just 25 euros a month, using simple tools that thousands of people are already using, without needing to be a stock market expert. In this video, we will go through the essentials so you can get started today. Investing simply means putting your money into something that has the potential to grow, like companies, property, or funds, instead of leaving it idle in a bank account. Why does this matter? Because prices almost always rise over time, a process called inflation. If your money isn't growing, it's quietly losing buying power. But here's where investing makes the difference. It doesn't just keep you level with rising prices, it can actually grow your wealth. Thanks to compound interest, once your money earns returns, those returns start earning returns too. And the longer your money stays invested, the stronger this effect becomes. Let's say you invest just 100 euros a month until retirement at 65, earning around 10% a year. If you start at age 20, you could have over 1 million euros by the time you retire. Wait until 30, and that drops to about 380,000 euros. Start at 40, and you'd end up with only around 130,000 euros. That's the power of time. Starting early, even with small amounts, is one of the smartest financial moves you can ever make. Investing isn't just about beating inflation. It's about giving your future self a real freedom. Before you even choose what to invest in, you need to ask yourself why you're investing. Are you building wealth for retirement, saving for a house in 10 years, or simply looking to grow your money faster than inflation? Your time horizon, how long before you need the money, will shape your investment choices. The longer your horizon, the more risk you can generally take. But risk tolerance isn't just about time. It's also about how you feel when markets drop. Be honest with yourself. If you see your investments drop by 20%, will you panic and sell, or will you stay calm and stick with your plan? Understanding this will help guide your mix of assets. That mix of assets is called asset allocation, which defines how you split your money between different types of assets. There are two main categories: equities, also called stocks, and bonds. Stocks are like owning tiny slices of companies. They can grow a lot over time, but will bounce up and down along the way. Bonds are more like lending money to a government or company. They are typically more stable, but their returns are lower. Many investors use a combination of both. A common example is a 60-40 split, 60% in stocks for growth and 40% in bonds for stability. Some go more aggressive, like 80-20 if they're younger and can handle more volatility. Others go more conservative, like 40-60 if they want less risk. Then there's the geography question. Do you go all in on Europe, US, Asia, or invest globally? Sticking to just one region or even country increases the impact of any political or economic events on your investments. A global approach, on the other hand, spreads your money across many countries, reducing the risk that one region's struggles will wipe out your gains. But of course, you can always get more specific later as you gain experience. At this step, many beginners would probably try to pick the most popular and stable companies in different regions and buy their stocks one by one. But that quickly becomes overwhelming. You won't just lose money on fees, you'll also end up spending a lot of time tracking dozens of stocks, instead of keeping your focus on long-term goals. That's where index funds come in. Instead of buying individual companies separately, index funds let you own all of them at once in a single package. For example, one fund can hold the top companies in Europe, US, or even the entire global market. And here's why that matters. Research from S&P Dow Jones Indices shows that over a 20-year period, about 90% of actively managed stock funds underperformed most of the indexes they were trying to beat. If even professionals who spend their lives picking stocks can't consistently outperform the market, retail investors have almost no chance. As John Bogle, the founder of Vanguard, one of the largest investment companies in the world, famously said, "Don't look for the needle in the haystack, just buy the haystack." In other words, don't waste time trying to find the next winning stock. Own the whole market through low-cost index funds. If you want to see a full comparison of index investing versus individual stock picking, we covered that in detail in another video. However, you can't buy index funds directly. Instead, the easiest way to access them today is through ETFs, or exchange-traded funds. ETFs give you instant diversification, low costs, and the chance to match the market's long-term growth instead of falling behind. Many ETFs are designed to simply follow well-known indexes, like the largest companies in Europe or globally, making them simple, predictable, and beginner-friendly. For retail investors in Europe, the key thing to know is that you can't buy US-domiciled ETFs because they don't provide the required key information document. Instead, you'll find UCITS ETFs, which are EU-regulated and designed for European investors. The good news is that these ETF versions track the exact same major indices, like the S&P 500 or NASDAQ, so you're not missing out on anything. And if you want to explore what's available, you can visit the Just ETF website, which is specifically built for European investors. It allows you to search, compare, and filter thousands of ETFs across all asset classes based on variety of characteristics, making it much easier to find the right options for your portfolio. Now that you know why ETFs are such a powerful tool for beginners, the next step is deciding how to invest in them. One of the easiest and most reliable approach is called dollar cost averaging, or DCA. We greatly recommend watching our full video about DCA strategy and learn its advantages against active investing. But let's quickly discuss how it works. You invest the same amount of money at regular intervals, every week, every month, or every quarter, no matter whether prices are high or low. This automatically buys more shares when prices are down and fewer when prices are up, smoothing out your cost over time. This consistency is more profitable over the long term than trying to time the market. JP Morgan found that over the past 20 years, missing just 10 of the best days in the US stock market could cut your overall returns nearly in half. Those best days often come right after big drops, exactly when emotional investors tend to sell. DCA keeps you invested through those rebounds, which is where much of the long-term growth happens. It's about time in the market, not timing the market. When you combine DCA with a broad, low-cost ETF, you're stacking the odds in your favor. Instead of trying to pick the right stock at the right time, which even professionals rarely get right, you're steadily buying into the entire market over time. All right, you've decided to invest, built a strategy, selected assets and their mix, but then comes the big question: where do you actually do it? That place is called a broker. A broker is simply a licensed platform that gives you access to the financial markets, allowing you to buy and sell investments like ETFs and stocks. But not all brokers are the same, and the one you choose can have a big impact on your investing experience. Here is what you need to consider while choosing a broker. First, try to keep fees as low as possible, whether it's per trade or monthly, because over time, those little charges can eat into your returns. Second, make sure the broker offers a wide range of instruments, especially UCITS ETFs, which are EU-regulated funds with strong investor protections. Third, avoid apps which make you feel like trying to read an ancient map. Pick something you are comfortable to work with. And finally, make sure your broker is regulated in your country or somewhere in the EU. That way, your money will be safe even if something goes wrong with the company. To make it simple, here's how brokers can be grouped. First, there are beginner-friendly apps like Trade Republic, Trading 212, Scalable Capital, Revolut, N26, and Lightyear. Easy to use and great for getting started. Then, there are low-cost do-it-yourself platforms with access to wider markets, such as DeGiro, Interactive Brokers, Saxo Bank, Freedom24, and XTB. And finally, you have bank brokers, your own bank's investment platform. They're familiar and convenient, but often come with higher fees. So now that we've gone through all the steps and you know how to get started, let's talk about the common mistakes many beginners make and how you can avoid them. Number 1, overcomplicating things. You don't need 10 different ETFs or complex strategies that you don't fully understand. In fact, keeping it simple not only saves you time, but also makes it much easier to stick with your plan for the long term. Number 2, ignoring fees. A 1% here and a 0.5% there might not sound like much, but over a long time, those little numbers can cost you thousands and thousands euros. And number 3, letting emotions to take decisions. When prices rise, people get greedy. When prices fall, they panic and sell. The key to success is to have a simple plan and stick to it, no matter what the headlines say. You don't have to be rich, you don't have to be an expert, and you definitely don't have to wait. Investing doesn't have to be complicated or scary. Start with a small regular amount, spread it across different assets, and let time do the work for you. The sooner you begin, the more your money can grow through the power of compounding. The steps you take today can create the freedom and peace of mind you'll enjoy tomorrow. Thanks for watching. Now go take that first step toward your future and subscribe to our channel to build your wealth in a smart way.